Hello and welcome to C-Suite Secrets. I'm Heather Parsons, your host. I'm a serial entrepreneur, fractional CFO, and a business value strategist. I've spent years juggling business and family life while helping entrepreneurs scale, optimize cash flow, and build real financial success. On our show, we bring you real conversations with founders, executives, and operators about what actually moves the needle in business. No fluff, no filler, just smart strategy, systems that work, and insights that you can put to use in your business right away. With that, let's dive right in. Normally, this is the part where I introduce a guest, but today we're doing things a little bit differently. Today on C-Suite Secrets, it's just me and you. This is episode 3 of our 12-part series, Think Like a CFO. And this series is designed to help you understand what's actually happening inside of your business finances, not just what your reports say, but what they mean for your growth, your profit, and the decisions that you make every single day as a business owner. This isn't about turning you into an accountant. It's not about complicated formulas or memorizing financial terms. It's about learning how to see your business through the lens of a CFO so that you can stop guessing, stop reacting, and start making intentional, confident decisions. Because most founders, they don't struggle with money because they're bad at business. They struggle because nobody ever taught them how to interpret their numbers and what they actually mean. And that's what we're going to start changing. In today's episode, I'm going to walk you through how CFOs see revenue differently. Hopefully, as you learn more, you will start looking at your business through the same lens, and a lot of the fog will begin to lift around your numbers. So with that, let's get started. If I told you that your company just closed its best revenue quarter ever, bigger than any quarter in your company's history, would you celebrate? Most leaders would say yes, without even a second of hesitation. But I've sat in boardroom meetings where that exact quarter, the best quarter ever, turned out to be the beginning of the company's decline. Not because the numbers were fake, the revenue was completely real. It just wasn't good revenue. That's what today's episode is all about. The belief that more revenue automatically equals a better business. It's one of the most deeply held assumptions in the corporate world, and almost nobody says it out loud as a strategy. It just quietly operates in the background of how companies run. You can see it everywhere once you start looking. In board decks where the top line growth chart sits front and center every single time. In sales compensation where reps get paid on bookings, not on the long-term health of what they've actually booked. In press releases where record revenue gets all the glory as an achievement, even if there's no context attached. In how founders pitch investors, where revenue growth rates become the North Star metric above almost everything else. And look, I understand why. Revenue is tangible. It's easy to measure. It's easy to put on a slide. It's easy to compare quarter over quarter. Compare that to something like customer lifetime value. Adjust for churn risk. That becomes quite different. That doesn't fit neatly into a headline or an Instagram post, and it definitely doesn't get applause in an all-hands meeting. But here's where that belief starts to break down, and I want you to really sit with this. Revenue is nothing more than an output. It is not the thing itself. It is the visual tip of a much bigger iceberg that includes how that revenue was generated, who it came from, how sustainable it is, and what it actually cost you to get it. Two companies can both report $10 million in annual revenue. One of them is healthy, compounding machine that gets more valuable every single year. The other can be a ticking time bomb, held together by a handful of fragile relationships, same numbers on the same line in the same spreadsheet format, completely different business underneath it. So, if the number alone can't tell you which one you're looking at, then treating more revenue as an automatic win, I'd argue is one of the most dangerous assumptions a leadership team can make. Let me walk you through a composite example drawn from patterns I've seen repeatedly across a lot of different companies, not one in particular. Picture a SaaS company that lands a massive enterprise client. Huge logo, 6-figure annual contract, everybody celebrates. The all-hands shout out, champagne in the office, the whole moment. 18 months later, that same client represents 40% of the company's total revenue, And now that client starts asking for custom features built just for them. Then discounted renewal terms because they know exactly how dependent that company has become on their contract. Then they start threatening to walk unless engineering resources get reprioritized entirely around that specific request. The revenue is real. The growth on paper, real, and it's wonderful. But the company had quietly built itself around a single point of failure. That's not a revenue story anymore. That's a huge risk. Just wearing a normal revenue costume. This is the trap. Revenue volume feels like progress because it's visible and it's immediate. But volume without quality is just exposure with better PR. And that's exactly what we're going to unpack next. So, if raw volume isn't the right lens, what is? This is where I want to introduce the concept that should sit right next to revenue in every single leadership conversation: revenue quality. Revenue quality asks a completely different question than revenue volume does. Volume asks how much came in. Quality asks how good is what came in. Here are the signals that actually separate the two, not just vibes, but things that you can genuinely measure in your business right now. When it comes to predictability, is revenue likely to repeat itself next month, next quarter, or next year? Recurring subscription revenue and multi-year contracts are a fundamentally different animal than a one-time project fee or a single large purchase order. $100,000 of predictable recurring revenue is worth more in valuation terms, in operational planning, in how confidently you can hire against it, than $100,000 in one-off revenue, even though the two numbers look identical sitting side by side on your P&L. Next, I want to talk a little bit about margin. Not all dollars cost the same to deliver. Revenue that comes with thin margins because you had to discount heavily to close it, or because fulfillment costs are high, or because you had to throw in several extra services just to win the deal, that revenue is quietly more expensive than it appears on the surface. I've watched companies grow top line revenue by 30% in a single year while actually profitability barely moved an inch. They're working harder than ever for no real upside because the growth itself was margin negative. I also want you to think about customer concentration. We've already touched on this a little bit with that enterprise client example, but if losing your top 3 customers would sink your business, your revenue quality is objectively lower than a company with the exact same total revenue spread across 500 customers. Concentration equals fragility, even when the top line number looks equally strong on both sides. Let's dive into that for a minute. Customer concentration. Whenever you think about all of your revenue that's coming in, I've seen this in a business recently. If your top 2 or 3 clients bring in all of your revenue, they're the ones that can make an exit super difficult. I saw this firsthand with the business I was looking to acquire not even a year ago. They're able to dictate terms that are very different than what you as a business owner might want to accept in a long term. Next, cost of acquisition versus lifetime value. This is the one that quietly kills more companies than almost anything else on the list. If it costs you more to acquire a customer than that customer will ever generate in its lifetime, quite frankly, you're buying a vanity metric. You're buying revenue that gets you nothing at the end of the day. You're paying to make your top line look good while destroying value underneath. And this will eventually come out. This shows up constantly in growth stage companies chasing metrics for their next funding round. The revenue is real, but the underlying economics are broken. This always gets caught whenever you look to sell your business or you're looking to get funding or bring in more investors. They're going to look much deeper than that vanity metric and it's your revenue. After that, we want to look at churn. Revenue that walks out the door in 6 months is not the same as revenue that sticks around for 6 years. We want those sticky clients. $1 of revenue from a customer with 95% annual retention, compounded year over year. $1 of revenue from a customer with 40% annual retention has to be replaced constantly just to stand still. And replacing it costs you more every single time you do it. And it costs your team a lot in time and a lot in effort. And they usually get dissatisfied and leave right along with your client. Next up is strategic fit. This one gets talked about the least, but it matters just as much. Does the revenue pull your company towards the business that you actually want to build or away from it? Sometimes a deal technically makes you money, but it drags your team into building one-off custom features that nobody else really wants, distracting your roadmap for months, and that revenue can be quality negative, even when it's profitable in isolation, purely because of what it cost you strategically. Here's the mental model I want to leave you with in this section. Picture two dials on a dashboard instead of one. The first dial is revenue volume. This is your sexy metric, the number that everybody's watching constantly. The second dial is the one that most companies never build at all. It's a composite revenue quality score, something blended: predictability, margin, concentration risk, acquisition efficiency, and retention into a single read. A healthy company wants both dials climbing together, but when you only have one dial on the wall, you have no way of knowing whether you're actually building a stronger business or just a louder one. All right, now let's make this practical. If you're running a company or sitting on a leadership team of one, how do you start actively questioning which revenue deserves your attention instead of treating every dollar as equally worthy of celebration and investment? Here's the framework that I want any executive team running every single quarter. Think of it less as gospel and more as starting a checklist. The first question I want you to ask is, if the revenue stream doubled, would our business get stronger or more fragile? For my construction folks, I want you to pay particular attention to this one. This single question does an enormous amount of work on its own. If doubling a low margin, low retention, single customer revenue stream would actually increase your risk profile, that's a massive signal that you should not optimize to grow it, even though on paper it's technically more revenue. This is super important if you don't really know what your profit margins are on every single thing that you offer to start with. You need to start with knowing what your job margins are and how profitable every single offer that you have is every single time you offer it to a customer. That way, you know if you're going to cut it too deep whenever you offer discounts to clients, so that you're going backwards, not forwards when it comes to net profit. Question 2, what it costs us to lose this revenue tomorrow? Not emotionally, operationally. Would you have to lay off a team? Would a covenant on a loan get triggered? Would your valuation take a disproportionate hit reflective to the actual dollar amount involved? If the honest answer is a lot, that revenue deserves active management attention right now, not a passive celebration on the sideline. Question 3, are we paying more to keep this revenue than it's actually worth? This applies directly to discounted renewals, high-touch support demands, and custom work. Sometimes the honest answer is that a customer, even a well-known or prestigious one, is no longer worth what it costs you to serve them. This is really important for folks who have that year-over-year discount question. You need to know, are these customers costing you, or are they making your business money and moving it forward? Question 4, does growing the revenue line move us towards the company we're trying to build in 3 years or away from it? Whenever I think about this question, one of the first things that comes to mind is values. Do we align on values? Am I working with clients who are equally yoked? Are they somebody who wants to move forward in the same ways and for the same means? This forces a strategic lens onto a decision that usually is treated as purely financial, and it often changes the answer entirely. You want to think about, is this revenue going to cost me in the long term? Am I taking clients now that my future business would not want to be associated with? If the answer is yes, that revenue might not be worth it in the long run. Question 5. If we could only reinvest in one revenue segment next year, which one compounds the most? This is the question that should actually drive resource allocation, not which segment is the biggest, but which segment, if fed and invested in, grows into the healthiest version of our business over time. I want to be really clear about something here. This is not an argument against growth. It's not an argument for shrinking your revenue or turning down good deals. It's an argument for discernment. Growth with discernment is what actually builds enterprise value that compounds year after year. The best operators I've come across don't ask, how do we get more revenue? They ask, how do we get more of the right revenue? And they're willing to actively walk away from or deprioritize revenue that fails this test, even when it's uncomfortable and even when it means a smaller number on next quarter's board slide. Okay, now let's put this into practice. So let's bring this all the way down to something that you can actually do this very quarter. Because a framework only matters if it changes behavior. Start by segmenting your revenue, not by product line, which is how most companies already slice it, but by the quality signals we just walked through. Break it down by customer concentration, by margin, retention rate, and predictability. You don't need a perfect model to start. You need a rough first pass that lets you actually see the shape of what you have instead of looking at blended aggregate numbers that hide everything interesting that's going on underneath it. For my construction folks, this is super important. You may think, well, I don't really know what my revenue streams are. Think about it like this. We're going to break it down by job. If you're doing construction, if you're doing plumbing or electrical, septic, think about what you're actually selling here and start to break it down. And this is the way we're going to look at it. And once you can see these numbers that we're talking about, patterns tend to jump out at you fast. You'll often find that the shockingly small slice of your revenue, sometimes 20 or 30%, is doing almost all of the compounding work. High margin, high retention, low acquisition cost. These folks are strategically aligned with where you're headed. And you'll often find another slice that looks fine on the surface, but is quietly expensive, fragile, and actively pulling your team in the wrong direction. Sound familiar to anybody? Rework is the first thing that comes to mind here. Are you going back out to fix something time and time again? Also, here's the shift I would challenge every leadership team to make. Stop asking your team to hit a single revenue number and start asking them to hit a revenue number with quality constraints attached, especially your sales folks. Growth targets that come with margin floors, growth targets that come with concentration limits, growth targets that account for retention, not just new bookings. The moment you attach quality constraints to a growth target, you change what your entire organization optimizes for sales, to customer success, to product. I'd also encourage you to change what gets celebrated internally. If the only thing that gets a shout out is the size of a deal or a contract, you're training your team to chase volume. If you also celebrate high retention rates, healthier margins, not going out to do rework, and a diversified customer base, you're training your team to chase quality. Culture follows incentives far more reliably than it follows mission statements. And here's the last piece, maybe the most important one. Revisit this analysis regularly. Don't just do this once. Revenue quality shifts quietly over time. A healthy customer base can slowly become concentrated. Margins can erode gradually through the incremental discounting that nobody's tracking or consistently talking about. The companies that avoid a nasty surprise are the ones that check this on a recurring cadence. Quarterly is usually a reasonable rhythm for most organizations. Or better yet, do this once a month. Pick one revenue stream and look at it every single month. You definitely want to do this more than once. You want to have your eye on it so that you notice well before a major customer is ready to walk out the door. So here's what I really want you to take away from today's conversation. Revenue is not a single uniform thing. It has texture. It has risk embedded inside of it, and it has a cost structure hiding underneath the headline number. And the moment that you start treating every dollar as interchangeable, you lose the ability to see which parts of your business are actually getting healthier and which parts are quietly getting more fragile behind a growing top line. Before your next leadership team meeting, do one thing. Take your revenue and break it into segments by concentration, margin, retention, and predictability, and just start to look at it. Not to make a decision yet, just to actually see what's there, because you can't manage what you haven't looked at honestly. More revenue is a headline. Revenue quality is the real story underneath it. Thank you to everybody for listening to C-Suite Secrets. If you have found today's conversation as valuable as I have, be sure to hit that like and follow button. But most importantly, share this episode with somebody who is building a business. And if you're at the point in your business where you're working harder than ever and your business is growing, but you feel like you're not keeping as much cash in your pocket as you should, or your numbers are just a mystery, that's exactly why we built our One Room. It's a hands-on way to simplify your numbers, understand what's actually driving profit, and start making decisions like a financially minded CEO. If you want more information between episodes, join us on Facebook at C-Suite Insiders Group, or come find me on Instagram at Heather Parsons Official. Until next time, keep growing, and remember, you don't have to do this alone.